Welcome to the deep dive. We're here to cut through the noise and really get to the heart of important ideas.
That's right. And today, we're tackling something I think is, well, genuinely fascinating.
It's this paradox, isn't it, about how we use history, especially when it comes to money and markets. Yep.
Exactly. History is, fundamentally a story of surprises, things that hadn't happened before.
Right. Events that were totally unprecedented at the time.
Yet, we have this tendency, almost a reflex, to treat it like a roadmap for what's next, like an instruction manual.
It reminds me of that quote from Stanford professor Scott Sagan. He said, "Things that have never happened before happen all the time."
It's such a great quote because it captures the irony perfectly. We want predictability, naturally, especially with our finances.
We look back hoping to find certainty, some kind of guide.
But if history's main lesson is surprise, how can it be a reliable blueprint? The future's bound to have its own shocks.
So our goal in this deep dive is really to help you, the listener, calibrate your thinking on this
Yeah, help you spot these common pitfalls of using past data and maybe gain a more nuanced view of the future of money.
without getting totally lost in all the numbers and charts.
Precisely, because that urge for comfort in the past, that leads directly into this trap we're calling the historians as prophets fallacy.
Okay, let's unpack that. The historians as prophets fallacy. What is it really?
It's basically an over-reliance on historical data, thinking it's a clear signal for what's coming next.
Especially in investing, right, where things seem to change so fast.
Exactly. Innovation, change, they're constant, but it's tempting to view investing like, say, geology or medicine.
Ah, okay. Because in those fields, the basic principles are pretty stable over time.
Right. A geologist can study rock formations from millions of years ago and apply those principles today. Doctors know kidneys worked basically the same way 1,000 years ago as they do now.
There's that underlying consistency.
Yes. But investing,
Mhm.
it's just fundamentally different.
How so? Aren't there economic laws or something?
Well, it's driven by people. Millions of people making imperfect decisions with limited information.
And emotions get involved.
Hugely. Nerves, greed, fear, paranoia. Even the smartest people are susceptible. It brings to mind Richard Feynman's famous line.
Oh, the one about physics.
Yeah, imagine how much harder physics would be if electrons had feelings.
Uh-huh. That perfectly captures it. That's investing.
It really is. And it means the foundation of economics isn't stability, it's actually constant change.
Nothing stays great forever. Nothing stays terrible forever. Things shift.
Right. Think of Bill Bonner's analogy of Mr. Market with his capitalism at work t-shirt and a sledgehammer. He's always changing things.
Because what drives it, all the stories we tell ourselves, what we want to buy that changes with culture, with generation.
It's always evolving. It never just sits still.
And that constant motion, that unpredictability, that leads to the first big danger you mentioned.
Yes, exactly. The first major danger of leaning too hard on history is that you're very likely to miss the really big shifts, the outlier events.
The game changers, not just small market bumps.
No, we're talking about the truly record-breaking stuff, things that seemed almost impossible before they happened.
Like the Great Depression.
Definitely. Or World War II, the dot-com crash, 9/11, the 2008 housing crisis.
These weren't just blips. They reshaped everything.
They had an absolutely massive, outsized impact because they set off chain reactions, cascading consequences.
It's wild to think about individuals, too. Like, how different would the world be if just a handful of key people never existed?
It's a powerful thought experiment. Take maybe 7 figures from the last century or so. Hitler, Stalin, Mao, Gavrilo Princip.
Yeah.
But also Edison, Bill Gates, Martin Luther King.
Their absence would have created entirely different timelines.
Unquestionably. Billions lived, but the actions of a few had disproportionate global effects.
The same with events, right? Think of the 20th century without, say, World War II.
Or the Great Depression, the Manhattan Project, antibiotics, the internet's precursor, ARPANET, 9/11, the fall of the Soviet Union.
Just a handful of things out of countless events that fundamentally altered the path we're on.
Absolutely. And the compounding effect is often missed. Let's take 9/11 again.
Okay.
19 hijackers. Seems like a specific terrible event, but follow the ripples.
Right.
The Fed cuts rates drastically in response. That fuels the housing boom.
Which then leads to the bubble and the crash in '08.
Exactly. Then you get a terrible job market post-crisis. Millions decide college is the only path forward.
Leading to a huge increase in student borrowing.
And now we have $1.6 trillion in student debt with a default rate over 10%. It's not intuitive to link 19 hijackers to today's student loan crisis, but the chain reaction is there.
It's like that failure of imagination idea Nassim Taleb talks about.
Precisely, like the Egyptians only planning for the worst recorded Nile flood or Fukushima built for the worst past earthquake.
They analyzed the past, but couldn't imagine something worse happening.
Yes. The problem wasn't lack of data, it was a failure to conceive of something truly unprecedented.
So what's the real lesson from surprises then?
Daniel Kahneman put it beautifully. He said the correct lesson isn't, I'll never make that mistake again.
Okay.
It's realizing that the world is surprising. Full stop. It's admitting we really don't know what's next.
We shouldn't use past surprises to define the limits of future ones.
Exactly right. So if you want one prediction that holds up,
What's that?
it's that the next big thing, the event that truly moves the needle for the economy and markets, will likely be something history gives us very little warning about.
Something unprecedented.
Mm-hmm.
And because it's unprecedented, we won't be ready.
Which is partly why it has such a big impact. Surprise is the constant mover.
Okay, so that's the danger of missing outliers. What was the second big danger?
The second one is ignoring structural changes. History can be misleading because the underlying systems, the very way the economy and markets work, change over time.
Ah, so the context shifts.
Dramatically. Think about your own personal finances. The 401k plan, it's only about 42 years old.
And Roth IRAs came even later, in the 90s.
Right. So how Americans save for retirement today, the advice they get, the analysis, it's not really comparable to what someone faced a generation or two ago. The tools are different.
That makes sense. What about other areas?
Venture capital is a huge one. 25, 30 years ago, it barely existed as an industry.
Really? It seems so dominant now.
It is now, but think of Phil Knight trying to fund Nike early on. He wrote there was no VC back then.
Wow.
So all our historical data on startup fund cycles, failure rates, investment patterns, it's based on a relatively short and very different period. The landscape is completely new.
And even the big public markets like the stock market have changed.
Oh, fundamentally, the S&P 500 index is a good example. Financial stocks weren't even in it until 1976.
I didn't know that.
Now they're a huge chunk. Tech stocks were tiny 50 years ago. Now they dominate.
So all the rules changed too, right? Accounting, disclosures.
Exactly. How companies report earnings, how audits work, how easily you can trade stocks market liquidity, all vastly different.
It seems even basic things like how often recessions happen have changed.
That's another great example. Back in the late 1800s, the U.S. had recessions roughly every couple of years on average.
That often.
Yeah. Early 20th century, it stretched to about 5 years. The last 50 years or so, it's been more like 8 years between them.
And we just had a really long stretch without one recently.
The longest since before the Civil War, actually. Whether it's better economic management by the Fed or the shift from manufacturing to services, the point is the underlying pattern, the structure, has changed.
This makes me think about investment gurus like Benjamin Graham. His book, The Intelligent Investor, is considered a classic.
Absolutely. A foundational text for value investing.
I remember reading it when I was younger, looking at all the historical data.
Yeah.
And his formulas seem like, a magic key, step-by-step instructions to get rich.
That's the allure, isn't it? Specific rules based on past success. But what happens when you try to apply those specific formulas today?
Well, yeah, that's the thing. A lot of them don't really work anymore, do they?
Often, no. Like his rule about buying stocks for less than their net working assets or avoiding stocks trading above 1.5 times book value.
Right.
If you strictly followed those today, you'd likely end up owning mostly very distressed companies, or maybe just specific sectors like financials, not quite the diversified path to wealth he intended.
So was Graham wrong or just misunderstood?
He wasn't wrong for his time. He was incredibly successful. But the key, as Jason Zweig pointed out when updating the book, is that Graham himself was constantly adapting.
He didn't stick to the same formulas forever.
Not at all. He was always experimenting, retesting. Zweig noted he'd discard old formulas from previous editions and replace them with new ones. He updated the book 5 times.
He practiced what he preached about analysis, even on his own methods.
Exactly. And near the end of his life, in 1976, someone asked him if his famous detailed stock analysis was still the best approach.
What did he say?
He said, in general, no. He admitted he wasn't an advocate of those elaborate techniques anymore because, and this is his quote, the situation has changed a great deal since then.
He acknowledged the world was different.
Explicitly. He mentioned more analysts, better technology, economic shifts, basically the structural changes we've been talking about. Even the prophet knew his specific prophecies had an expiration date.
It's funny how the further back you look in investing history, the more you're looking at a world that just doesn't exist anymore in the same way.
Which brings us neatly to that phrase everyone loves to mock. It's different this time.
Ah, yes. John Templeton supposedly called those the four most dangerous words in investing.
He did, but the irony is Templeton himself admitted that, well, maybe 20% of the time, it is different.
Huh. So even he knew things change.
Right. And those changes are often the most important things to understand. Michael Batnick had a great comeback to that.
What was it?
He said, the 12 most dangerous words in investing are, the 4 most dangerous words in investing are, it's different this time.
That's brilliant. It highlights the danger of automatically dismissing the possibility of real change.
Exactly. So the takeaway isn't ignore history. Not at all.
But use it differently.
Yes, the further back you look, the more general the lessons should be. Focus on the timeless stuff.
Like human psychology, greed, fear.
Precisely. Those don't change much. But specific trends, trades, which sectors are hot, what causes market moves, those are constantly evolving.
So recent history might actually be more relevant for specifics because the underlying structures are more similar to today.
Often, yes. It requires a nuanced approach. History provides context, not a crystal ball.
Okay, so let's pull this together. We've dived deep today and found that history, while valuable, isn't a perfect map for the future.
Right. 2 main reasons. First, the world is shaped by huge, unpredictable outlier events that history can't really prepare us for.
And second, the fundamental structures of the economy and markets are constantly changing, making old data less relevant over time.
So instead of looking to history for a detailed map, maybe the better approach is cultivating imagination.
Imagination for what could happen, rather than just what has happened.
And building resilience. Preparing for surprises rather than trying to predict them precisely.
So the question for you, the listener, is this. Knowing that the future will bring surprises, knowing that the ground rules will shift, how do you plan for your financial future?
How do you avoid getting caught in those traps of relying too heavily on past data?
Maybe the answer lies less in forecasting and more in preparing for a world that will always surprise us. Something to think about.